Hi, everyone. Welcome to our webinar. Thank you for taking the time out of your busy day to join us. We're really glad you're here. I just have a couple of things before we get started. If you called in by audio only, we encourage you to join us on another device so that you can view the presentation as well. This webinar is being recorded and the recording will be made available on the aleragroup.com website as soon as possible. Please be sure to post any questions in the Q&A section on your screen so we can get those answered at the end. And I'll be posting a link to download the slide deck here shortly. That'll be found in the chat section. And that's my spiel for today. I'm going to hand it over to Justin to get us started today.
Thanks, Caroline. I want to welcome everybody today to our first installment of our Surety webinar series. As Caroline said, I'm Justin Price, the Surety Director and all-around Surety enthusiast here at Propel. I want to make sure to thank you all for joining us today. I know I speak for everyone to say that we are privileged and excited to be presenting to such an outstanding and broad group. We have such a wonderful team here at Propel who are always eager to help. We are all about collaboration and service, and this presentation is a pure reflection of that. I'm actually really proud of the team for what they put together for you today. We all did our best to make sure we kept this one light and informative for our broad audience. There will be questions, so feel free to ask. So now I'm going to give it away to my team manager, Carly Espiritu, who will take the lead from here. Take it away, Carly.
Thanks, Justin. We are excited to share with you today Surety 101, the basics. By the end of our presentation, we hope to provide you with a general understanding of what surety is and the initial process involved in obtaining surety credit. Before we get started, please take a moment to take our quick poll. How would you rate your understanding of surety? 1 being, what is surety? I'm new to the game completely. And 5 being a surety expert. I have a well-rounded understanding of surety and the process of obtaining credit. I'll give you a few seconds to take our poll. And it looks like the results are in. Most of you have a moderate understanding of what surety is, so we will get started. The team presenting to you today are all members of the Propel Bond Department. Our Surety Director, Justin Price, already introduced himself. I am pleased to introduce the rest of our team. Myself, Carly Espiritu, Team Manager for the Surety Department. Mandy Keltner, Surety Team Lead for the Commercial Surety and Southeast Surety Team. Jamie Marcus, Senior Account Manager on our Contract Surety Team in Tacoma, Washington. Annalise Ritchie, Account Manager on our Commercial Surety Team in Tacoma, Washington. Sherry Hill, Senior Account Manager on our Contract Surety Team in Columbia, South Carolina. Christopher Kenyon, Senior Account Manager on our Commercial Surety and Contract Surety Team in Tacoma, Washington. Our agenda for today will be covering the following: what is a bond, the parties involved, common bonds, who requires bonds, the general indemnity agreement, how do clients get bonds, and ending with a Q&A. Please feel free to ask questions via the chat or Q&A. Our team will be monitoring those and we will go over the questions at the end during our Q&A session. Thanks again for joining us today. Our presentation team has over 75 years of combined experience within surety, and we're very excited to be presenting today. Now I'm going to hand it over to Jamie Marcus, who's going to go over our first bulleted item, what is a bond?
Thanks, Carly. Hi, everyone. First and foremost, let's clear up a very common misconception. Bonds are not insurance and vice versa. We will dive into some of the common misunderstandings and major differences amongst the two. Here are the fundamentals of surety bonds. Surety bonds and traditional insurance are provided by insurance companies and are both licensed and regulated by state insurance departments. However, surety is unique in which the surety company's financial resources back the contractor's commitment to enter into a contract with an owner. Keep in mind, there are no losses anticipated in surety, whereas with insurance, losses are contemplated in its rate making. This ties in later to the indemnity agreement. There are 3 parties to the surety agreement: the principal, the obligee, and the surety company. Insurance is only a 2-party agreement between the insured and the insurer. Coverage is project specific and is 100% of the contract price for performance and 100% for payment up to the penal sum of bond. Coverage Bond forms could be generic and provided by the surety company, or most of the time provided by the obligee. If provided by the obligee, the bond form would need to be reviewed by the surety company, and if not favorable, the form would need to be negotiated by both parties. A claim is legal action taken by the obligee against the principal when the conditions of the bond or the law are violated. Bonds are required by law in public projects or voluntarily by private owners. Mandy will go into more detail on this topic later. A bond is a guarantee. The obligee wants to know that if there were to be a claim on the bond, that someone is legally held responsible to pay said claim. A surety bond is a promise to be liable for the debt, default, or failure of another. It is a three-party contract by which one party, the surety, guarantees the performance or obligations of a second party, the principal, to the third party, the obligee. What you want to know is it's not as simple as just buying a bond. There is a process in order to obtain. The surety company reviews items such as financials and credit to determine if they're comfortable vouching and providing a guarantee for the principal. Clients need to qualify for surety credit via the underwriting process. The surety underwriting process is a little more in depth, and there are qualification guidelines that need to be met. We will talk about this process later on. Now, Chris is going to go into detail about the roles of the producer and common bonds for contractors. Chris, take it away.
Thank you, Jamie. So the surety bond producer plays an essential role in helping the client obtain surety bonds, being an integral part of the client's external advisory group. Outside of the producer, this group typically includes attorneys, lenders, and accountants. By using his or her specialized knowledge of the industry in which they focus, the producer prepares the principal for the surety company's pre-qualification process and helps the principal establish a business relationship with the surety company. Communication and information flow are key. So the principal is the contractor, or you, getting the bond. The principal is the party that has an obligation to a second party. A principal can be a contractor, an individual, or any other entity that needs a bond. Typically, the principal enters into a contract whereby it agrees to perform according to the contract's terms and conditions. The surety is the guarantor on the bond. So as an example, in exchange for the bond premium, the surety guarantees to the obligee that the contractor will perform the contract as written and pay subs, suppliers, and vendors. The surety is the corporate entity legally responsible for paying claims if a principal has defaulted. And then the owner or obligee is the beneficiary, and it can be various institutions, municipalities, cities, counties, private companies, etc. In line with our previous example, an obligee is the project owner who contracts with the principal or contractor for the performance of a contract. And for all of you subs out there, it's good to know that the obligee could also be a general contractor with whom you contract for the performance of a subcontract. So the three common bonds for contractors in connection with specific contracts are the bid bond, which is filed at the time of the bid, and it guarantees that the contractor will enter into the contract and provide performance and payment bonds if they're awarded the job. The performance bond guarantees that the contractor will perform the obligations outlined within the contract. And then the accompanying payment bond guarantees that the contractor will pay all laborers, material suppliers, and contractors per contractual obligations. And then for another example, developers in particular may need subdivision bonds, which provide a guarantee to a municipality that public improvements will be satisfactorily completed and protection from financial harm will be in place if the contractor defaults. Now, Annalise will cover the common bonds that we as an industry generally label as commercial exposures.
The most common types of commercial bond exposures are license and permit bonds. These bonds guarantee the performance of obligations required by the underlying license and/or permit. Most of these are for specific city, state, county, and municipality. For example, contractors license bonds, right-of-way permit bonds, and motor vehicle bonds are a few we come across pretty consistently. License and permit bonds typically require a short form application and indemnity. These bonds are confined under a more expedited underwriting process. Public official bonds guarantee the honesty and/or faithful performance of official duties, which may include receiving, collecting, properly accounting for all public funds and property handled by that office. Court bond is a general term, and it's used for all surety bonds when needed by individuals or entities when they're involved in pursuing an action in the court of law. The two main categories are judicial and fiduciary. Some common examples are release of lien, probate, guardianship, injunction, and appeal. The underwriting requirements on these vary. Miscellaneous bonds, such as loss securities and depository bonds, tend to have unique purposes that do not fall easily into one classification. With some of the commercial exposures, we have specific departments within Propel that assist us in placing these bonds. Now I want to touch briefly on average and typical cost of surety bond exposures. For example, in construction, rates vary from company to company and also depend on the size and type of project, as well as the contractor's overall bonding needs. Bid bonds, there's usually no cost for the bid, although the contractor includes the cost of the potential performance and payment bond within their bid number provided. The performance and payment bond costs will ultimately be covered by the obligee as a part of the contract, but only if the contractor includes that cost in their bid. The performance bond premium is generally 0.5 to 3% of the contract price, closer to 3% if the SBA Surety Bond Guarantee Program is used. Otherwise, premiums generally range between 0.5 to 2.5%. Payment bonds, there's usually no charge for the payment bond when it is purchased in conjunction with the performance bond. If a payment bond is needed on a standalone basis, which is not as common, then surety will look to charge a reduced rate for that bond. License and permits bonds are typically 1% of the bond amount and renew annually, which is typically credit-based. Subdivision bonds are typically 1 to 3% of the bond amount, and court bond pricing depends on the bond amount and can require collateral at times. Now I will be turning it over to Mandy Keltner, who will help us understand why bonds are required.
Thank you, Annalise. So who requires bonds? Per the Miller Act of 1935, surety bonds are required on all public works projects with federal funding over $100,000. The Miller Act of 1935 was implemented for the safety and protection of the taxpayer. The taxpayer is protected because the performance and payment bond guarantees the project owner will only pay once for the construction of the project. Bonds are also statutorily required when the project is funded by other public means, such as state, municipal, or county. The laws that address bonding in each state are referred to as the Little Miller Acts. Federal, state, county, and municipal laws dictate the requirement of a surety bond for various commercial and miscellaneous exposures. General contractors can request that their subs and potentially their suppliers to provide a surety bond to guarantee their contract and portion of the work. We also consistently see bond requirements within the private sector, which is not governed by the Miller Acts or Little Miller Acts. These typically can funnel through a lender or bank requirement looking to protect capital being provided. When a bond is required via a lender or bank, a dual obligee is typically involved. Dual obligee is when the protections of the bond are extended to the financial lender as well as the project owner. This is done via dual obligee rider. Now, there are many benefits of contract surety bonds. As an impartial third party, the surety pre-qualifies the contractor to verify the contractor is capable and qualified. This will reduce unqualified competition within the marketplace. With a performance bond, the owner has assurance of project completion, as the contractor has again been qualified and vetted by the surety. This is the first line of defense against contractor default on a project. In the event of a default, the bond provides owner protections against financial loss on the project. With a bonded project, the owner and surety will work together if there is a default of the contractor. And if the contractor requests help, the surety may offer technical, managerial, or financial assistance. This can help the project move forward and can significantly reduce the likelihood of a default. The payment bond guarantees that first and second tier subcontractors or suppliers will be paid. For private project owners, surety bonds relieve the risk of liens filed by unpaid subcontractors and suppliers. In the absence of liens, the transition from construction to permanent financing is much smoother. Bonds on public work are for the safety and protection of the taxpayer, the ultimate owner. Bonds on private work are for the protection of the project owner and sometimes also the financing entity. When subcontractors and suppliers know they are protected by a payment bond, they may present lower quotes since they no longer have to absorb a risk of non-payment. Now I will give it back to Jamie to help us better understand the concept of indemnity.
Thanks, Mandy. Indemnity is the lifeblood of the surety. It is the promise by the principal to make the surety whole should they suffer a loss as a result of the principal's failure to fulfill the commitment for which it's bonded. In many instances, the surety not only has recourse against the company that defaulted, but also against the personal assets of its owners. Indemnity can be taken in two ways: a single application or the signing of a general indemnity agreement, which is basically a blanket indemnity for any and all bonds issued from that point forward. It needs to be stated, in order to obtain surety credit, an indemnity will need to be taken. Now, Sherry is going to go over how to get a bond and the 3 C's of surety. Sherry, take it away.
Thank you, Jamie. The 3 C's of surety are the backbone of determining whether a principal qualifies and can obtain surety credit. While character has always been an important C, sureties are placing more and more weight on a principal's character because it is the key to a successful relationship. In evaluating character, a surety company will assess whether a company is trustworthy enough to fulfill its obligations under the contract. A surety will look to the principal's reputation in the market, including successes with prior projects and operational integrity, such as promptly paying its suppliers. Capital: a surety must ensure that a principal has the financial strength to be able to complete a project and fulfill its obligations under a contract. As such, a surety will evaluate a principal's balance sheet, focusing on current cash and receivables, current liabilities and installment debt, as well as its banking relationship and ability to maintain a line of credit for short-term borrowing purposes. Capacity. When a surety looks at a principal's capacity, it looks at the ability of the principal to complete the project under contract. In addition to examining financial ability, the surety looks at a principal's technical ability, examining past performance on similar size and scope projects, as well as resumes on key employees within the organization. The surety must be assured that owners, managers, and key employees have the experience and expertise to execute the work and complete it per the specs of the contract. This chart illustrates the items we need to complete the underwriting file that ultimately establishes the 3 C's of surety and to meet the standard underwriting requirements. To illustrate, this is what we would typically request when dealing with a contractor client. For character, we will ask for recommendations and sub-references. For capital, we will need financial statements, work in progress report, and a bank line of credit. For capacity, we like to have key employee resumes, business plan, and an organizational chart. The 3 C's apply to everyone looking to qualify for surety credit. They are and always have been foundational to the surety underwriting process. Now, Carly will wrap us up.
Thank you, Sherry. This slide provides our current org chart within the department. Our headquarters is in the Pacific Northwest, but we have offices throughout the country. We continue to expand our presence and have expertise all over the country. We strongly believe we have the strongest and most experienced team out there and are ready to assist with any issues that you may have. Now it's time to have some fun with a little Q&A. It looks like we have a couple questions in the Q&A right now. One regarding a bid bond, and looks like it's for WashDOT. A WashDOT bid, and if they will accept electronic signatures. I know that we are working on that as a whole. There's also Surety 2000 that we have for WashDOT electronic bids. I'm not sure who is all on there, if this contractor is actually on there or not, but that's another great resource for electronic bidding through WashDOT.
And Carly, one other point to that. Thanks for the question, David. Appreciate it. I think we're moving to in that direction. I think COVID really helped us out in that regard. The surety and insurance industry is kind of slow to make major changes like that, especially when it comes to guarantees of a bond. But yeah, we are seeing more of people accepting DocuSign even, and Surety 2000, which would make it a lot easier, so you don't have to worry about missing it on bid day. Hopefully that answers that one. What's the next one, Carly?
The next one is regarding SDI or subguard default insurance in place of a bond.
Yeah, I mean, I can take that one. So Eric, thanks for the question. Great question. So that would only be in place on private work. It's not an acceptable alternative on public. Bonds would be required over 100 grand, publicly or federally funded. I would say it's the SDI or subguard. Subguard is more of a specific policy based on a certain carrier. I would say this. Really, those are for a lot larger size jobs, tens of millions of dollars of exposure. The smaller the work, it doesn't really make sense. It really is to the project participants, on private work, to make sure you carefully consider the overall risks and benefits on each option. We do see some of the SDI, CDI contractor insurance being placed on the larger work with the larger GCs. But when it comes to the smaller work, we do have some carriers that are providing that as an option, but it's not as much yet.
And then another question from Eric, do we charge for bid bonds? No, we do not. The next question is from Wendy. Can we share the PowerPoint? We will have this recorded and we will be able to share it.
There's one more question, I think, just came in.
And then it's regarding if a lender can request a bond, subguard insurance after the project has already started.
I would say yes. We don't see that typically, Wendy, great question. But they can do that. It's really a negotiation between the general contractor developer with the lending institution. They can come in and actually ask for it. There's always leverage if it's not within the contract to be required to push back upon the lender, which I would suggest you do if they come in after the fact. But if they do, and the project's already ongoing, what sureties typically request are all rights letters or affidavits of obligee and general contractors, just making sure that the reason why they're requesting the bond is not because the contractor's having issues and there's lack of funding, etc. So we do see it and they can do it, but there is leverage for the GC or the developer to push back after the fact if it's not within the contract documents.
Thank you, Justin. It looks like we posted the slide deck in our chat. So if anyone wants to download that for the PowerPoint, you can. We'll just wait another minute if anyone has questions, concerns.
Yeah. I think that's
Thank
it.
you.
You guys made the Q&A easy on us.
Yeah, that was
Or we just did a fantastic job of the presentation, which I think that's the case.
That is always the case.
that was pretty easy. No, thank you, everyone. Thank you for all your great questions and taking time out of your busy day to join us today. We appreciate each and every one of you. That wraps up Surety 101, the basics. Hopefully you're all on your way to becoming surety experts. Thank you and have a great rest of your day.
Thanks,
Bye,
everybody.
everyone.